So how major are the changes then to taxes when it comes to that medium-term budget policy statement delivered today by the Finance Minister, Enoch Godongwana? Let's chat to Charles de Wet, tax executive at ENS Africa, joining us now. Not much, by the way, of those income tax sort of conversations then in this one, Charles. But it will get interesting that we need to be a little bit aware that the best way for the country to, I suppose, get any more money is going to be through increased taxes somehow.
Yeah, hi, Arabella. I mean, that's exactly the point. At some point in time, we're going to have to up the revenue collection. I mean, sort of historically, we don't expect today to be a big tax announcement. Most of the tax announcements are made as part and parcel of the February budget. What was significant, though, and that also typically happens on a day like today, is the final tax amendment bill was introduced by the minister at the beginning of his speech. And there's some interesting sort of telltales in that lead to the broader tax conversation. Now, you may recall that in the budget, the minister announced that there was a program to reduce the corporate tax rate because we are not really competitive in international terms. But that was connected to two particular policy directions, and that was a limitation on the deduction of interest, and then also a limitation on the transfer of assessed losses. Now, there was quite a lot of reaction when that was put into the draft legislation, and a number of commentators pushed back against that. What's interesting in what is in today's documentation is that while they have amended and accepted some of the changes, those provisions are still there, but what they have done is it will only apply from a date to be announced in the future. It won't come into effect immediately. Now, that's an interesting direction to do things. It means that they believe they've had the debate and they don't want to have it again, which, I think gives a little bit of certainty, and at the same time maybe indicates that, sort of a reduction in corporate tax rate is still on the cards.
Sure. I mean, if that reduction were to come in place, though, I mean, would that really increase sort of the investment in the country, for example? Because some would say, okay, well, you have lower tax rates. It means that, we're going to get charged less and we have more revenue to kind of invest in this country. Do you think that really becomes the case if that was to kind of be it from a tax perspective?
That was certainly the conventional thinking, sort of before COVID-19 hit us, that there was a global pressure to reduce tax rates, and we saw a number of countries doing that. So we were certainly not competitive from that perspective. But what we have seen recently is that the UK pushed up its tax rate. So I think there's been a little bit of a reverse around that. But there is some sort of, if you look at the detail of the projections and the tax revenue going forward, there's some sort of interesting clues in terms of what their strategy may be as far as that's concerned.
Yeah, I think that's certainly going to be one to kind of watch really for really where to from here as well on that front. Do you see any other changes, happening in near term, even if it is just, next year, to kind of find more money? Doesn't look like that is going to be the next one in that sense, because we've already done that maybe 3 or so years ago. Increasing the actual income tax, that may be a tough one. If you decrease corporate tax, that may be, the next thing, but that doesn't necessarily help your fiscus too much as yet. The other thing you could possibly do is just increase that sugar tax, but that won't add enough to the fiscus, surely.
No, so sugar tax, all those smaller taxes, while they generate some money, there's not very much of that they generate. So that won't make a difference. If you look at the trend in the, for the next 3 years, one of the sort of hallmarks almost of the South African tax system is that individuals carry the biggest burden of tax. And if you look at that, that's been sitting close to 40%, and it seems to in the next 3 years, stay at that kind of level. The increases are quite big, though, in relation to sort of economic growth and so on. If you look for 2022, they almost projecting an 11% increase for individuals. But in 2023, and this seems to be when the corporate tax rate will be reduced, there's a big reduction in that. But what you're seeing as part and parcel of that trend is a bigger move to indirect taxes. Whereas traditionally VAT has pretty much had it about 25% of the total tax take. In the next 3 years, it seems to be heading up to about 30%. I don't see a rate increase in that, though. As you say, we had a rate increase in 2018, and I've always believed that this is the place where they could collect more money. But very much is focused about what Commissioner Kisbet has said in terms of the efficiencies, the money that they've been spending at SARS. The windfalls that they've got in the mining industry, kind of taking advantage of that, but also increasing their efficiency and collecting more tax off the back of that. So that kind of seems to be the direction that they're moving in.
Always good chatting to you then. Charles de Wet, Tax Executive at ENS Africa. Thank you so much for that time. Indeed, income tax certainly the most critical and important part there. The one driving force, of course, to that budget time and time again.